When a stock performs well, it is expected that more people will buy the stock, and bulls come and they become even more bullish. But what happens when bulls and big fans start selling their shares? Tesla investor Cathie Wood and her firm Ark Invest have recently sold Tesla's shares to buy shares of other companies. This is the first time in a long while that Cathie Wood is trimming her Tesla shares in order to buy another stock, and Tesla fans are wondering if this really is the time to hold on to their shares. Hey guys, welcome back to Tesla Tomorrow. Cathie Wood recently unloaded a total of 139,642 Tesla shares worth around $26.84 million, based on the closing price of the stock at the time. Wood's firm Ark Invest sold 119,630 shares from its Ark Innovation ETF, and around 20,012 shares from the Ark Next Generation Internet ETF. With this, Wood and Ark purchased 320,557 shares of payment processor Block, worth $19.84 million. The purchase was made via the flagship Ark Innovation ETF, the Ark Next Generation Internet ETF, and the Ark FinTech Innovation ETF, all of which had Block amongst their top 5 holdings. Ark Invest also bought shares of Coinbase and Teladoc. Since Wood's funds offloaded a large chunk of Tesla's shares, this sale ignites curiosity because until recently, Ark funds have been buying Tesla shares. So why has Cathie Wood sold her Tesla shares? Let's find out, but before we do, if you like this type of content, hit that like button, make sure to subscribe to the channel, and turn on notifications to keep up to date on everything going on with Tesla. Prior to the sales, Wood's fund had bought over $4.6 million worth of Tesla shares. Ark added $12.6 million in Tesla stock on March 8th after loading up to 1.3 million shares in December and January. Wood's recent purchases came during Tesla's 12.2% drop, its largest single-day decline since September 2020. According to reports, funds backed by Ark Invest bought more than 176,000 shares of Tesla in the first US trading session of the year. The purchases came as Tesla stock plunged 12% after the company missed estimates for quarterly deliveries despite offering hefty incentives. At the time, Wood's exchange-traded funds had acquired slightly more than 938,000 Tesla shares since the 3rd of October 2022 when it started its latest buying streak. Some analysts claim that Cathie Wood sold Tesla shares because they were above 14% of the fund's portfolio. According to investment analyst Alexandra Mers, the rule is that Ark can no longer add shares of a company once it is above 10% of the firm's portfolio. However, while this could be a reason for the sale of Tesla shares by Cathie Wood's firm, it is also important to note that Tesla bull Ron Barron has around 52% of his assets in Tesla, in just one of his funds. Also, Mers cited that although shares cannot exceed 10%, there are no rules stating that it should be trimmed. So does this mean Cathie Wood is no longer bullish on Tesla stock? Probably not. Wood is known to be a very strong Tesla bull, and while she may have sold some of her shares, it does not suggest that Wood is now bearish on Tesla. In fact, the stock expert believes that Tesla stock will bring massive gain for its investors in the future. Wood predicts that the stock price could go as high as $4,600 by 2026. This was after she had predicted a $3,000 stock price by 2025. Cathie Wood is a big fan of the stock market, and her flagship exchange transfer fund has made many investors millions in the past as she is constantly on the lookout for the next big thing on the board. Wood has high hopes for Tesla. The Ark Invest CEO bought Tesla shares on the day of its biggest plunge since September 2020, and this reaffirmed her conviction in the EV maker. Wood claims that Tesla will be the big winner of the AI revolution and autonomous driving. The journey to autonomous vehicles has just begun, and Tesla seems to be leading it. In fact, 2022 to 2024 has been said to be the most optimistic period for electric vehicle sales as new electric vehicle models will be launched. According to Cathie Wood, the possible shift to battery-powered automobiles is anticipated to drive the electric vehicle market, and this market is expected to grow from $287.36 billion in 2021 to $1,318.22 billion in 2028, rising above the 2020 drop caused by the pandemic. Likewise, Ark Invest CFA Tasha Keeney has said that autonomous driving is expected to drive more than 60% of Tesla's value over the next 5 years. Cathie Wood, like Ark Invest, is not only betting on Tesla's potential for autonomy but its entire car business. The firm has its 2026 price target for Tesla at $500 per share post-stock split. based on electric vehicles alone, and there are several catalysts that can cause this to happen. Tesla's grade rating has recently been upgraded by credit rating company Moody's. Moody's became the second credit ratings firm to endow Tesla with investment grade status, upgrading the firm's credit score by one notch to bar 3. The firm cited Tesla's expanding product offering, including early production of the Cybertruck later this year, as part of the consideration for the upgrade. Tesla's financial policy and management's operational track record were also taken into account, as well as its regional production facilities and heightened focus on efficiency and its financial leverage. According to Moody's, Tesla will maintain its position as one of the leading manufacturers of battery electric vehicles, as the company further solidifies its global footprint. The rating changes reflect the agency's expectation that Tesla will remain one of the foremost manufacturers of battery electric vehicles with expanding global presence and very high profitability. Moody's upgrade follows a similar move by S&P Global Ratings in October. The S&P Global Ratings announced last year that it raised its long-term credit rating on Tesla from BB+ to BBB, which is the automaker's first investment grade rating. The rating company stated that Tesla has surpassed its expectations on many metrics. According to the S&P, it views Tesla's credit profile more favorably because the automaker continues to demonstrate market leadership in electric vehicles, with solid manufacturing efficiency that supports strong EBITDA margins and sustained positive free operating cash flow. The firm believes that Tesla will maintain low debt levels as it sustains its solid market share, profitability, and strong liquidity amid a weakening economy and an increasingly competitive environment for electric vehicles. While this upgrade may not be important for the average investor and Tesla shareholders, it is a big deal for Tesla as ratings below investment grade may prevent some large funds from investing in the company. Some large funds often have a policy not to invest in companies that have anything less than an investment grade rating. As of now, Tesla may not be in dire need of debt financing, and the rating upgrades could benefit the automaker by bringing in the positive sentiment attached to them. The electric vehicle maker is operating in a capital-intensive industry, and it has several promising projects, products, and service opportunities in its pipeline. If, at any time, Tesla decides to tap the debt market, these upgrades can come in handy. Moody's uplift has both symbolic and practical value. Companies that rise from junk to investment grade typically benefit from cheaper financing by attracting a deeper pool of investors. And traditionally, a high-grade credential from at least two agencies is enough to be formally considered a blue-chip credit among ratings-sensitive investors. Here's one way to look at it. Tesla was already being treated like a blue-chip company by many investors and analysts. It secured a $5 billion revolving credit facility earlier this year, a sign that it is nearing investment-grade status. According to data compiled by Bloomberg, Tesla has little outstanding debt, and its first 5-year credit default swaps are already trading in line with high-grade borrowers. Together with its new rating, Tesla's continuous innovations have placed it in a very advantageous position. The car company recently released a new software update activating its vision-based park assist feature. In October 2022, Tesla stopped including ultrasonic sensors in the Model 3 and Y vehicles. These ultrasonic sensors were used for short-range object detection. Tesla said at the time that it planned to move to a fully vision-based parking system, using the myriad of cameras around the car in order to estimate distances and provide park assist functions, without the added complexity of these additional ultrasonic sensors. And indeed, Tesla delivered on this in less than 6 months. This and several other incredible updates are what set Tesla apart from other car companies, and it will take a while before anyone can come close. Do you think Tesla stock is a good buy at the moment? Let us know down below, and if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there!